Okay, we are going to talk about one of the simplest ways to summarize data using frequency distributions. A frequency distribution is a tabular display of data summarized into a relatively small number of intervals. This is a frequency distribution. This is for the returns on the S&P 500 index, by the way. And as you can see, we have a number of intervals here and a bunch of other columns that we will talk about all of them in detail later and how to make one. And you will see how useful it can be when we are dealing with a lot of data without summarizing it using frequency distributions. It is going to be very difficult to find out any important information about the data. And when I say data, in our case, what we care about the most is going to be rates of return, and maybe it's not a bad idea to talk about how we can get those returns before we talk about how to make a frequency distribution table, which is pretty simple, really. And a good starting point would be holding period return, right? Now, for the holding period return, we need three things. We need a beginning price, we call it P0, the ending price, P1, and any cash distributions if we have received any. And in terms of cash distributions, if you're talking about common stocks, it is going to be the the dividends. And if you're talking about bonds, it will be the coupons on the bonds, right? This is the formula. And as you can see in the formula in the numerator, it's very clear that all we're saying is that, okay, how much did you gain? A P1 ending price minus the beginning price, and plus any cash distributions if you got any, over whatever we started with. So any gain or loss over the initial price. Now let's do one quick example so we know what we're doing here. Let's say the price of a stock, doesn't matter what stock, in the year 2014 it was $100, and then in 1 year later, 2015, it became $140. And we also got a $10 dividend at the end of the year, right? So pretty easy. Our ending price 140 minus the beginning price, starting price 100 plus the $10 dividend that we got, everything over the initial price, $100, right? So obviously price-wise, we've made $40, and we also got $10 of dividends. So overall, we've made $50, everything over 100, so 50%. So the holding period return for this year, the annual holding period return would be 50%. Now let's say we go on for another year. Let's say the year 2016, the price, let's make this one a negative one. Let's say the price became $110, right? And we also got that $10 dividend anyway. So let's calculate the holding period return for this year. Now, my ending price, 110, minus my beginning price, this time is 140, plus the $10 dividend, everything over the initial price, this time is 140. Okay, now it's clear that price-wise, I lost $30, but I got $10 of dividends, so overall minus 20 over 140, right? That will be 14.28 minus 14.28%. So the holding period return for this year, for the second year, would be minus 14.28%. Pretty easy, right?